This wasn't just another trading day. Silver was exploding, momentum was building, retail traders were watching closely, and institutional money was positioning aggressively. Open interest was high, volume was increasing, and price action was pushing toward a critical level just as first notice day approached. Then suddenly, right before first notice day, the market froze. Trading was disrupted, systems experienced issues, orders were delayed, and price feeds became unstable. When normal trading resumed, the explosive momentum was gone, the rally cooled off, and the upward pressure that had been building for days seemed to vanish almost instantly. This happened less than 24 hours before first notice day, which is the first day futures contract holders can be required to take physical delivery of silver. In futures markets, most contracts are settled in cash, and only a small percentage result in actual physical delivery, but during periods of strong demand or tight supply, more traders may choose to stand for delivery. That is where things become sensitive. If too many participants demand physical silver and supply is constrained, the system can experience stress. Volatility tends to spike around these moments because large short positions may face pressure and the balance between paper contracts and physical metal becomes more visible. In this case, silver had been climbing steadily, short sellers were under pressure, and speculation was growing that delivery numbers could be significant. Then the disruption occurred. Officially, exchanges can and do experience technical failures. High-frequency trading, heavy volume, and algorithmic order flow can overload systems. There is no confirmed proof that this interruption was intentional manipulation. However, critics argue that similar disruptions or sudden rule changes have occurred during strong silver rallies in the past, including margin requirement increases or trading condition adjustments that cooled off bullish momentum. The timing is what fuels suspicion. When an interruption happens during upward acceleration and just before a key contract date, traders naturally ask who benefits. When markets halt in the middle of a rally, short sellers receive breathing room, volatility decreases, retail momentum weakens, and risk exposure for large institutional players can stabilize. This does not automatically imply wrongdoing, but in financial markets timing is everything. Silver is traded heavily through paper futures contracts, and for every ounce of physical silver, multiple paper claims may exist in the system. As long as confidence remains high and most participants settle in cash, the structure functions smoothly. Problems arise only if confidence weakens and more traders demand physical delivery simultaneously. Some analysts believe disruptions during critical moments help maintain stability in a highly leveraged paper system, while others insist such events are normal risk management procedures designed to protect market integrity. After trading resumed, silver prices stabilized and the breakout attempt faded. Delivery figures ultimately did not produce the extreme squeeze some had anticipated, and the broader system continued functioning without collapse. Yet the debate remains alive because trust is fundamental in commodity markets. If traders begin to suspect that key moments consistently coincide with technical failures or sudden changes, confidence erodes. Silver occupies a unique position in global finance because it is both an industrial metal and a monetary asset, influenced by inflation expectations, geopolitical tensions, central bank policy, and speculative flows. Its volatility makes it attractive but also controversial. Whether this disruption was coincidence or a perfectly timed stabilization event depends largely on perspective. What is undeniable is that even brief interruptions during high-momentum phases can shift billions of dollars in positioning and alter the psychological landscape of the market. As long as paper contracts dominate and physical delivery remains a small fraction of total volume, discussions about the deeper issues surrounding events like this goes beyond a single trading interruption and touches the structural mechanics of modern commodity markets. Silver futures are not just speculative instruments, they are risk management tools used by miners, refiners, industrial manufacturers, bullion banks, hedge funds, and retail traders across the world. Every contract represents an agreement tied to future expectations of supply, demand, inflation, currency strength, and macroeconomic stability. When price momentum builds rapidly ahead of a key contract milestone like first notice day, the stakes rise significantly because leverage magnifies both gains and losses. A strong rally can create cascading short covering, where traders who bet against price increases are forced to buy back contracts to limit losses. This buying pressure can accelerate price movements even further, creating a feedback loop that intensifies volatility. If such momentum continues into a delivery window, it may shift the balance between paper positioning and physical settlement expectations. In highly leveraged systems, stability depends on orderly price discovery. Exchanges are designed to maintain that order, sometimes through volatility controls, circuit breakers, or margin adjustments. Supporters of the exchange argue that temporary disruptions or system pauses protect market integrity by preventing disorderly execution, flash crashes, or cascading algorithmic failures. They claim that without safeguards, extreme volatility could damage liquidity and confidence more severely than a brief interruption ever would. On the other hand, skeptics question whether these safeguards are applied consistently across bullish and bearish environments. They analyze historical charts, searching for patterns in which strong upward moves in silver encounter sudden friction, whether through technical issues, liquidity gaps, or rule changes. Even if each individual event has a plausible explanation, repeated timing near pivotal moments naturally invites scrutiny. Financial markets operate not only on rules but on trust in the fairness of those rules. Once participants begin to suspect asymmetry in how volatility is managed, narratives form quickly. Social media accelerates those narratives, spreading screenshots, order book anomalies, and speculative theories within minutes. In today's digital environment, perception can shape market psychology almost as powerfully as fundamentals. Beyond immediate price action, silver's broader macro backdrop also contributes to sensitivity. Inflation concerns, central bank policy shifts, geopolitical uncertainty, and currency fluctuations all influence precious metal demand. When real interest rates decline or economic instability rises, investors often seek hard assets as a hedge. Industrial demand from sectors like electronics, solar energy, and advanced manufacturing adds another layer of structural demand. This combination of monetary and industrial roles makes silver uniquely reactive to macroeconomic crosscurrents. When momentum builds under such conditions, traders interpret it not merely as a technical breakout but as confirmation of larger economic trends. Therefore, any interruption at that stage feels amplified in significance. Another factor is leverage concentration. Large institutional participants may hold substantial derivative exposure, hedging physical inventories or speculative positions. Sudden price spikes can trigger margin calls, forcing rapid capital adjustments. Exchanges must ensure that clearing members remain solvent, because counterparty risk is systemic. If one major participant fails, contagion can spread. From a risk management standpoint, stabilizing volatility is essential. Yet from a trader's standpoint, abrupt stabilization during upward pressure can feel like suppression. The tension between systemic stability and free price discovery lies at the heart of these debates. After the disruption, analysts carefully reviewed delivery statistics, warehouse stock levels, and open interest data. Some pointed out that registered inventories remained sufficient, suggesting no immediate shortage. Others argued that headline inventory numbers do not fully capture the dynamics of available versus encumbered supply. These nuanced technical arguments rarely make mainstream financial news but dominate specialist forums and commodity discussions. The episode ultimately underscores how modern markets blend physical reality with financial abstraction. Paper contracts vastly exceed physical output in notional value, yet price signals still influence real-world production decisions, mining investment, and industrial procurement. A brief technological interruption can therefore ripple through perception, strategy,